Investment banking is a method of controlling the flow of money with the goal of channeling cash from investors looking for returns into the hands of entrepreneurs and businesses who are long on ideas but short on funds. Investment bankers raise money from investors by selling securities and then transferring that money to people who need cash to start businesses or bring other costly projects to reality. Investment bankers get involved in the very early stages of funding a new project. They are typically contacted by people, companies, or governments who need cash to start businesses or finance projects. Representatives from the investment banking operation then find investors or organizations like mutual funds and private investors who have more cash than they know what to do with and who want a return for the use of their funds. Investment banks also offer advice regarding what investment securities should be bought or the ones an investor may want to buy. The difference between traditional banks and investment banks is the way money is transferred between the people and institutions that need it and the ones who have it. Instead of collecting deposits from savers, as traditional banks do, investment bankers usually rely on selling financial instruments, such as stocks and bonds, in a process called underwriting. By selling financial instruments to investors, the investment bankers raise the money that's provided to people, companies, and governments that have productive uses for it. The primary forms of financial instruments sold by investment banks include the following. Equity. Investment bankers help companies raise money by selling ownership stakes or equity in the company to outside investors. After the securities are sold by the investment bank, the owners are free to buy or sell them on the stock market. Equity is first sold as part of an equity offering called an initial public offering. Debt capital. Some investors have no interest in owning a piece of the company, but they are more than willing to lend money to it for a price. That's the role of debt capital. Investment banks help companies borrow money by issuing bonds or IOUs that are sold to investors. The company must pay the prearranged rate of interest, but it doesn't give up any ownership of the company. If a company falls into hard times, the owners of the debt have a higher claim to assets than do the equity owners if a liquidation of the company is necessary. If you're interested in this topic, we also have a video that explains how debt capital markets work. Hybrid securities. Most of what the investment banks sell can be classified as either debt or equity, but some securities take on traits of both. One example is preferred shares, which give investors an income stream that's higher than what's paid on the regular equity. All the functions of investment banks typically fall into one of the two primary categories, selling or buying. On the sell side, the investment bank is responsible for finding investors to buy the securities being sold, which raises the money needed by businesses and governments. On the buy side, investment banks may also take the role of advising the large investors who are interested in buying financial instruments.